If you cannot read support and resistance, you are trading blind. Richard Wyckoff would often remind students that the market leaves footprints long before it makes a major move. Support and resistance are those footprints, the invisible lines where the composite operator quietly absorbs or distributes while the public chases noise. Imagine price dropping into a well-tested support zone, volume dries up, the candles shorten, and the crowd panics out. Yet, the professional quietly steps in, absorbing every share. Moments later, price springs upward, leaving the amateurs wondering why it reversed exactly there. To master support and resistance is to understand where the real battle is fought, and where the smart money silently wins it. Ladies and gentlemen, if there is one skill that separates the emotional trader from the informed operator, it is the mastery of support and resistance. These levels are not just lines on a chart. They are the battlegrounds where supply meets demand, where fear collides with confidence, and where the composite operator quietly executes his agenda while the crowd reacts. Today, we are going to step behind the curtain and study these zones the way Wyckoff intended, not as fixed price levels, but as dynamic areas of business where accumulation and distribution unfold. If you want to trade with precision, consistency, and clarity, then mastering support and resistance is not optional. It is essential. Let's dive in. Understanding market structure is the foundation upon which all successful trading decisions are built, and in the Wyckoff method, it becomes the very language of the market. Market structure tells the story of the ongoing battle between supply and demand. Who is in control, who is losing ground, and where the next major shift is likely to happen. When traders fail to read structure, they misinterpret random price swings as meaningful signals. But when you learn to recognize structural phases, you begin to see the market the way Wyckoff saw it, as a carefully orchestrated cycle directed by the composite operator. At its core, market structure is the pattern of higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. Yet, in Wyckoff's eyes, this simple definition only scratches the surface. He believed market structure reveals the deeper motives of large operators who accumulate positions quietly, mark up prices swiftly, distribute gradually, and then mark down aggressively. Every shift in structure exposes their intentions retail traders typically overlook. For example, during an uptrend, support and resistance levels act like stepping stones for smart money. When price makes a higher low on declining volume, it often signals that supply is weakening. When price breaks a previous high on strong volume, it shows demand is in full control. The trader who understands this structure is not guessing. They're reading the footprints left behind by professionals. This awareness allows them to align their trades with the prevailing market cycle rather than fight against it. But Wyckoff also stressed that markets rarely move in straight lines. Instead, they transition through phases: accumulation, markup, distribution, and markdown. Each phase has its own structure, rhythm, and behavior. In accumulation, the structure is often tight and range-bound, showing the composite operator absorbing supply. In a markup, structure transforms into a series of rising supports and breakout resistances. In distribution, structure flattens and turns choppy as smart money sells into strength. Finally, in markdown, structure collapses with lower highs and failed attempts to reclaim lost support. Mastering market structure allows you to enter and exit trades with far greater precision. Instead of buying randomly, you wait for structure to confirm strength. Instead of selling out of fear, you allow structure to guide your decision. Support and resistance levels become clearer, breakouts become more predictable, and false moves become easier to spot. You begin to see the why behind every structural shift, not just the what. And perhaps most importantly, understanding market structure prevents emotional trading. When you know what phase the market is in, you stop chasing tops, buying into distribution, or panic selling during accumulation. You become a strategist instead of a reactor. This is how Wyckoff intended traders to operate, not by luck, but by recognizing the structural message the market communicates every day. Market structure is not just a technical concept, it is the trader's compass. When you learn to read it with clarity, the market stops being chaotic and starts being beautifully logical. In Wyckoff's teachings, the market is nothing more than the continuous interaction of two forces, demand and supply. Every candle, every level, every trend you see is simply the result of this push and pull. Support and resistance are not magical lines. They are zones where these forces shift dramatically. To truly master support and resistance, you must first master the understanding of demand and supply zones, for they reveal the intentions of the composite operator long before the public notices. A demand zone is an area where the presence of strong buying interest has previously overcome selling pressure. It is the birthplace of rallies, springs, and bullish reversals. When price returns to such a zone, it is not the level itself that matters. It is the behavior within that zone. Wyckoff would tell you to watch the character of price and volume. Is selling pressure drying up? Are down candles becoming smaller? Is volume contracting as price approaches support? These subtle details show that supply is being absorbed. The result is often a turning point where the crowd sells in fear, but the smart money steps in with confidence. On the other hand, a supply zone is where selling pressure has previously overpowered demand. These zones act as ceilings for price, where rallies lose momentum, where upthrusts appear and where distribution quietly occurs. When price revisits a supply zone, Wyckoff encouraged traders to observe. Are buyers failing to push past previous highs? Are up candles weakening? Is volume increasing on down swings? These clues signal that the composite operator may be unloading positions into the strength created by retail buyers. What makes demand and supply zones so powerful is that they represent the areas where professional traders have already committed significant capital. They don't place orders randomly. They build positions systematically over time and at specific price ranges. This repeated engagement turns these zones into consistent reaction points. The public sees support and resistance, but Wyckoff-trained traders see the underlying cause: accumulation and distribution. One of Wyckoff's greatest insights was that support and resistance levels are not exact prices but ranges. Traders often make the mistake of treating these zones as razor-thin lines and panic when price wicks below support or slightly above resistance. But Wyckoff knew better. The market will often pierce these zones intentionally. In a demand zone, a temporary drop beneath support can be a classic spring designed to trap sellers and load positions at a discount. In a supply zone, a brief break above resistance may be an upthrust designed to trap buyers before the market reverses aggressively. Understanding demand and supply zones transforms the way you trade. Instead of reacting emotionally to every wick or spike, you evaluate the true behavior of price. You stop fearing false breakouts because you can identify which ones are engineered traps. You begin to recognize when demand is strengthening or when supply is overwhelming the market. Most importantly, you develop the ability to anticipate reversals and continuations with significantly higher accuracy. To trade like Wyckoff is to focus not on what the market looks like, but on what the forces beneath the surface are doing. Demand and supply zones are the windows through which you see this hidden activity. When you learn to read them correctly, support becomes more than a floor, and resistance becomes more than a ceiling. They become the map of professional intent. In Wyckoff's view, the market is a calculated arena, one where the composite operator uses every tool available to accumulate and distribute positions without revealing his hand. Among these tools, liquidity traps are some of the most deceptive and powerful. These traps occur when price intentionally moves beyond a support or resistance level to trigger stop losses, attract breakout traders, and create the liquidity needed for large operators to execute their orders. Most retail traders see these moves as breakdowns or breakouts, but Wyckoff students understand that these are strategic operations designed to mislead the public and fuel professional campaigns. A liquidity trap forms because the market cannot move meaningfully without liquidity. Large players require volume, specifically opposing volume, to fill their massive orders. If they want to buy, they must create an environment where others are forced to sell. If they want to sell, they must engineer a situation where others are eager to buy. This is where support and resistance become hunting grounds. Retail traders often cluster their stop losses just below support or just above resistance. The composite operator knows this. By pushing price slightly beyond these levels, he triggers a cascade of orders that gives him exactly what he needs: liquidity. Consider the classic example of a spring. Price dips below a support level, triggering stop losses and attracting aggressive short sellers who believe the market is breaking down. Volume spikes, not because institutions are selling, but because retail traders are panicking. The composite operator then absorbs all this selling pressure, using the trap to complete his accumulation. As soon as his orders are filled, price snaps back above support, catching every trapped seller off guard. What looked like a breakdown was nothing more than a liquidity grab. The same logic applies to the upthrust, the bearish equivalent. Price breaks above resistance, enticing breakout buyers who rush in late to the move. At the same time, short sellers are forced to cover as resistance appears broken. This combination of forced buying and emotional buying creates a surge of liquidity. The composite operator unloads his positions into this strength, completing distribution. Once he is done selling, price collapses back below resistance, leaving breakout traders trapped in losing positions. The trap has been sprung. Wyckoff emphasized that these traps are not random, they are engineered. They reveal the true intentions of the market's strongest hands. To the untrained eye, liquidity traps look chaotic. But to the Wyckoff trader, they are predictable behaviors that show where smart money is active. The key lies in reading the character of the move. Was the breakout accompanied by genuine demand, or was it a brief spike with no follow-through? Did volume expand meaningfully, or did it only surge momentarily? Did price hold above resistance, or did it instantly fall back into the range? These are the clues that separate professionals from amateurs. Understanding liquidity traps transforms your trading. You stop being part of the herd that gets manipulated. You begin waiting for confirmation instead of chasing impulsive moves. You recognize the difference between a true breakout and a manufactured one. Most importantly, you start aligning your trades with the intentions of the composite operator instead of falling victim to them. In Wyckoff's world, the market is a chessboard, and liquidity traps are the hidden moves that catch the public off balance. Learn to spot them, and you'll never see support and resistance the same way again. In the world of Wyckoff analysis, very few concepts are as misunderstood and as misused as the breakout. Retail traders often see a breakout as a simple event: price crosses a line, so the trend must continue. But Wyckoff taught that a breakout is not the signal. The validation of that breakout is what tells the true story. Without validation, a breakout is nothing more than noise, and often a deliberate trap set by the composite operator to lure the unsuspecting crowd. Breakout validation is the disciplined process of confirming whether price is truly ready to move beyond a support or resistance zone, or whether it is merely probing for liquidity. A real breakout represents a genuine shift in the balance of supply and demand. For price to move beyond a well-tested level, the market must demonstrate strength, follow through, and acceptance beyond that level. Wyckoff stressed that this strength is visible not through the breakout candle itself, but through what happens after. The breakout is merely the initial test. Validation comes in the form of sustained behavior. Can price stay above resistance? Can it stay below support? Does volume confirm the move, or does it contradict it? True breakout validation begins with analyzing volume. A legitimate breakout typically shows increased demand in an upside breakout or heightened supply in a downside breakout. However, the key is not just high volume, it is the right kind of volume. For example, a rally that breaks resistance on explosive volume may look strong, but if that volume comes entirely from trapped short sellers covering, the move may lack real buying interest. Wyckoff traders study whether the volume reflects professional commitment or merely retail panic. Likewise, if price breaks a level on low volume, the move may lack the participation of large operators, indicating a weak or premature attempt at a trend. Next comes the critical phase of retesting. Professionals want confirmation that a previous resistance level has now turned into support, or that former support has turned into a ceiling. Wyckoff considered these retests as some of the clearest validation signals in the market. If price returns to the breakout level and holds it with firmness, showing small spreads, diminishing volume, and an inability of the opposing force to drive price back into the range, it confirms that the market has accepted the breakout. This acceptance suggests that supply has been absorbed or that demand has dried up, depending on direction. On the other hand, if price fails to hold at the breakout level, if it quickly returns inside the range, shows heavy rejection, or fails to attract participation, then the breakout is likely false. Wyckoff students recognize that such failed breakouts often precede powerful moves in the opposite direction because they reveal a lack of conviction from smart money. These failures are often the signature setups of the composite operator, a false push to trigger stops, lure momentum traders, and create liquidity for accumulation or distribution. Breakout validation protects traders from emotional reactions. Instead of chasing the initial thrust, Wyckoff traders wait for confirmation, understanding that missing the first candle is irrelevant in the broader campaign. What matters is aligning with the true direction of the market, not with the temporary manipulations engineered for liquidity. Ultimately, breakout validation is the difference between trading like the public and trading like a professional. It replaces impulse with logic, fear with patience, and uncertainty with structure. When you master the art of validating breakouts, support and resistance stop being fragile lines and start becoming powerful zones where the market reveals its true intentions. To understand support and resistance the way Wyckoff intended, you must understand the mind behind the market, the composite operator, ZCO. Wyckoff used this term to describe large institutions, syndicates, banks, funds, and highly skilled professionals who move the market with strategic precision. These players trade in such massive volume that they cannot simply enter or exit positions at will. Instead, they must operate through carefully orchestrated campaigns, accumulating, marking up, distributing, and marking down. Every action they take leaves footprints on the chart, and support and resistance levels are some of the clearest places where their intentions become visible. The composite operator does not see a chart the way retail traders do. A retail trader sees a line and thinks, "If it breaks, I'll buy." But the composite operator sees clusters of stop losses, fear, and predictable retail behavior. They understand where liquidity sits, where traders will react emotionally, and where the majority has placed their hopes or panic. As a result, support and resistance become essential tools in the CO's playbook, not as barriers, but as zones to extract liquidity, shift sentiment, and build or unload massive positions. For instance, during accumulation, the composite operator identifies a broad support zone where sellers are willing to unload their positions. Instead of buying aggressively and driving the price up prematurely, the CO absorbs supply quietly. Each dip into support is an opportunity to buy more. Price stays within a range because the CO keeps the market under control, preventing it from rising until their accumulation is complete. The retail crowd interprets this as sideways, boring movement, but the Wyckoff trader understands it as a silent campaign. Conversely, during distribution, the CO uses resistance zones to offload positions. When price approaches a known resistance area, the public sees potential breakout. The composite operator sees an opportunity to sell into demand created by enthusiastic buyers. The CO may even engineer a false breakout above resistance to create a surge of liquidity, triggering buying frenzies and stop orders. Once the liquidity is harvested and distribution is complete, the market collapses. Retail traders blame manipulation, but Wyckoff teaches that this behavior is simply the composite operator managing inventory. Support and resistance also reveal the CO's intentions through the character of price movements. If price approaches resistance with weakening volume and narrower spreads, it suggests that the composite operator is not supporting the upward move. If price dips into support with declining volume and immediate rebounding strength, it often indicates absorption. Professional buying beneath the surface. This is why Wyckoff emphasized that reading the story behind each movement is more important than simply identifying levels. Another hallmark of composite operator behavior is the creation of liquidity events around these levels. Springs below support and upthrusts above resistance are not accidents. They are designed to deceive the uninformed trader while allowing the CO to complete their business efficiently. These traps expose retail liquidity and provide the CO the opportunity to finalize their campaigns with minimal slippage. Ultimately, mastering composite operator behavior means learning to think like a professional. It requires patience, observation, and an understanding that the market is not random, it is purposeful. When you study support and resistance through the lens of the composite operator, you stop trading against the tide. You begin aligning with the market's most powerful force, and that alignment is what transforms inconsistent trading into strategic, confident execution. In the end, mastering support and resistance through the lens of Richard Wyckoff is not about drawing perfect lines. It is about understanding the intentions behind the market's movements. These levels become meaningful only when you view them as battlegrounds where demand and supply collide, where the composite operator quietly operates, and where the emotional behavior of the crowd becomes predictable and exploitable. By studying market structure, you learn to recognize the phase the market is in and trade in harmony with its direction. By identifying demand and supply zones, you uncover where institutions have placed their orders. By spotting liquidity traps, you avoid the painful mistakes that catch most traders off guard. By validating breakouts, you shift from acting impulsively to reacting intelligently. And by reading composite operator behavior, you elevate your analysis from basic chart watching to strategic decision-making. Support and resistance are not static, they are dynamic reflections of professional intent. When you learn to read them correctly, the market stops being a mystery. Patterns make sense, movements become logical. Your decisions become clearer, safer, and more consistent. This is the essence of Wyckoff's legacy: to trade with understanding, not emotion, to read the market's story, not its noise, and to operate with patience and precision rather than hope and haste. Master these principles and you move from trading with the crowd to trading with the professionals, where true consistency begins.